So today I want to talk about this book. Recently I've just read chapter 6. I believe it's chapter 6, I'm not sure, let me just check. No, chapter 5, yeah. So recently I've just read chapter 5 of this book. And it's quite an interesting chapter because it talks about the almost everything bubble. Basically, almost every major investment category is in a bubble, including real estate, stocks, and even debt, and even the stock market is so so it's in a big bubble. So they have a few graphs here. So this chapter is about. I'm not going to read the whole chapter. I'm just going to tell you the highlights of it. But it starts at page 63, and I believe it ends on page 80. Not that one. Page. Where was it? Page 82, I believe. Yeah, that's it. So it ends on page 82. So it's roughly 20 pages, 19 pages probably. But so it starts with giving a definition of what a bubble is. So a few definitions here. A bubble is a situation where asset prices are based on implausible views about the future, or an economic boom that often ends in a sudden collapse. A state of willful ignorance, hanging on to a groundless, unsubstantiated belief. So that is a few definitions of a bubble. So here he talks about measuring bubbles. So there's a few charts here. That's the first chart that he shows. There's another chart here, another chart there. There's 3 charts, 4 charts. There's 5, 6, 7, 8. There's a few charts that are useful for explaining the bubble. So I'm not going to read everything he says. I'm just going to read the parts about the chart. So here, if you look at this chart properly, this is the cap ratio, which stands for the cyclically adjusted price to earnings ratio. It's basically a PE ratio, but cyclically adjusted. So if you don't know what a P ratio is, the P ratio is the price of a share of a stock relative to the annual earnings that the company is making per share. In other words, if the P ratio is 15, then the price of the stock is 15 times higher than the earnings of the company. So if you look at this properly, this chart, it says a lot. If you cover everything after 1995, so if I cover up everything after 1995, roughly here, yeah, with your hand, you'll instantly see that whenever P ratios were over 20, the stock market was in a bubble, and every time it was below 10, the market was undervalued and an extreme bargain. Now look what I call the bubble century. From 1998 to today, there was only a brief moment where the stock market visited fair value. Otherwise, it has been totally insane for more than 25 years. So that's the first graph, the cap ratio over the last few years. So it's basically the amount of the price relative to the earnings of the stock market. So the higher the higher the price is in proportion to the earnings, and obviously the price shouldn't be too. This ratio shouldn't be too high, because that means that it could be overvalued, and it is. So the second graph is hours worked to buy the S&P 500. So I'm not going to read what it says there, but basically it's how many hours does someone have to work to buy one share of the S&P 500. I think it's per week. Let's see if it says it. Where was it? A low number of hours means that this market is undervalued. I can't see whether that is hours per week or hours per month. I don't know, but It must not be on a time frame like a week, month. It's just how many of hours are required. So obviously now, we need in as of 2020, people needed to work 120 hours to buy one share of the S&P 500. But ever since 1860 up until 1990, you never needed more than 40 hours of work to buy the S&P 500, and that spanned it over many years, 140 years. That range is 140 years. So ever since 1995, we've gone into uncharted territory with massive, massive, massive levels, with it going above 40. So that's another indication of the fact that the S&P 500 might be overvalued. And the S&P 500 is the main stock market index in the UK, in the US, by the way. So another graph here is the Buffett indicator. So the Buffett indicator gives you context so that you can see when the stock market is in balance with the economy, and when it's out of balance, when it's 30 to 50%. Oh, so this is so what is this one? This is Warren Buffett, considered many of the world's greatest investor, has chalked up a lifetime of success. He likes to use the size of the US stock market compared to the size of the US economy. So this must be like the size of the stock market compared to the economy. So the US economy, I think the GDP is like 19 or 20, it's around 20 trillion, but the stock market is worth 200%, meaning it's worth double the value of the GDP. So, but historically, it's always been below 100%, as we can see here, and every time it goes above 100%, it seems to crash. So right now it's way above, as of 2021. That's a couple of years ago, but it still must be still very high now. You can Google it, but that is very high. So let's see what else he says. Yeah, so that's 3 graphs so far. Let's look at the next graph. So the next graph is this one here. Stock market capitalization divided by GDP for I think this is for multiple countries, not just one country. So their study is summed up by aggregating all 17 countries into one chart. It's called an interquartile range. So that represents 17 countries, and that's the stock market size relative to the GDP of the 17 countries. I think they're the advanced countries. So even in the whole world, even in other countries, it's still above 100%. It's basically the Buffett indicator, but for the whole world. This is basically the Buffett indicator, but for the whole world instead. But let's see what other graphs they have. So here we can see that gold has made more gains than the stock market since the year 2000. So since the year 2000, gold has gone up 600% in gains, whereas the stock market, the S&P 500, has only gone up less than 200%. So he says a 60-year-old friend of mine has bet his retirement on the stock market. He figures that steady contributions to his individual retirement account, IRA, will mean he can retire at 65. I tell him that other than some cryptocurrencies, precious metals have been the best performing asset class of the century. And I counter his skepticism by showing him charts like this to prove the point. From the beginning of the century to when this chart was generated, the stock market is up about 150%, while gold is over. So basically, it's just talking about what happened in this graph. So obviously, if you invested in gold, you would have made a better return than the stock market. And this is the inflation adjusted chart. So when you adjust it for inflation, you can see that it's a lot lower than this one. So let's see, what's this? This is the federal funds rate and recession. So this is the bank interest rate set by the bank, so central bank, Federal Reserve. So just before a recession, see here, just before a recession, they ramp up the interest rate. Same here, just before the recession happened. The grey bar represents when a recession happened. Just before the recession happened here, they raised interest rates. Same here, they raised interest rates. In 1970, the same. Just before the recession happened, they raised interest rates. So the chart doesn't go to 2023, but as we all know, recently the central banks have been raising their base rates. The UK, the central bank in the UK, Bank of England, the Federal Reserve, the central bank of Europe, the European Central Bank, and that means that a recession is going to come either in 2023 or probably 2024. So get ready for that one, because this is showing, this is below like 2%, 1%. But as we know, the interest rate has been raised to roughly 5%, at least 5%. Depends what country you're in, but I think in the US it's way above 5% now. So as you can see here, it was raised above 5%, and that's when the recession happened. So it could happen again. So there's probably going to be a recession happening soon, according to that chart. But so yeah, there's a few more other charts. The last chart. This chart's important too. This chart represents corporate debt. So this is the level of corporate debt to GDP ratio. So corporate debt is 50% of the GDP, and we can see here that the level of debt has risen from 20% to 50% in the span of like 70 years. And yeah, so that's a good one. And this is the number of zombie companies. So the zombie companies are companies that can't afford to pay off the interest as well as the principal amount of their loan. So companies that had loans that are in debt, they can't even afford to pay off the interest, so they're having to borrow more money in order to pay off their debt. So they're borrowing money to pay off debt, which is getting them into more debt. But as we can see, the number of zombie companies has gone up to 20% in 2023, meaning 1 in 5 companies are at the brinks of bankruptcy. But as you can see, in the year 2000, it was like just above 3%. Now it's 20%. So that's very risky, because just imagine 1 in 5 shops, high street shops, boarded up if they all go out of business at the same time. And when a recession happens, that is what happens. That's why we can see here, this is when a recession happened. From 2008, 9, 10 to 2013, it went down. But if you see when the recession happened, you can see here, that was the 2008 financial crisis, between 2008 and 2010. So this may just look like numbers, but this is actual companies that went out of business and lost their business, and people that these businesses, when they went out of business, the employees became unemployed. So this is not good, and it's happening now. But this could go down all the way to 2%, back to its former levels. If that does happen, it's going to be the biggest recession ever since the Great Depression, probably. But yeah, that's just a few charts. Bonds are also in a bubble. Bonds. There's a few other charts, but those are the main charts. Anyway, thanks for watching. If you like this video, please hit the like button and the subscribe button, and I'll see you in the next video.